Hey everyone! This week we're digging into a new report by Mercury about sentiment in early stage startup world, including some surprising trends for AI-enabled companies when it comes to hiring. But first, SPVs are still for chumps and Anthropic is not having it. I'm Ashley and I'm joined by Helen and Sally this week. This podcast is brought to you by Mercury, the fintech used by over 200,000 companies to simplify their finances. We're huge Mercury fans at Great Chat, and we use it to run this podcast. A few of us are also current customers for our funds and startups, not to mention the dozens of founders we've backed as VCs, angels, and scouts that run their businesses on Mercury. If you are launching a startup or fund, visit mercury.com to apply in 10 minutes or less. Onboarding couldn't be more intuitive or delightful. Quick note, Mercury is a financial technology company, not a bank. For more details, check our show notes.
Hi, everyone.
Hey.
Hello. Is that not how everyone starts their meetings?
100%. Has anyone seen K-Pop Demon Hunter yet?
No.
What?
But
Okay, I've seen it
is...
at least 10 times because it is now a nightly ritual for our entire family to watch it after dinner. It's
I literally
so good.
don't even know what you're talking about.
Oh my gosh! Okay, I promise I'm not living in some bizarre corner of the universe. It is definitely a thing. It's like been number one on Netflix for weeks. No? You haven't heard of Hunters?
Hunters. I've just been in like a little bit of a work hole, so I'm glad I have our crew to enlighten me.
Well, it's a Netflix movie, but there's also like a killer soundtrack, and now, last weekend, like every movie theater in the U.S. had like a sing along. So like you join for these show times, and you go and you just sing along to the songs.
Wow.
Okay. Anyways,
Well, speaking of, just the follow-up from last week was, I don't know if you guys watched the Taylor Swift, Travis Kelce podcast. That broke the internet. So
I just saw all the screenshots with like the sort of concurrent viewers of the live stream. Like they not only broke the internet, they broke the record, right? So there's a new record set for simultaneous live stream views. And I was going to say we're going to break it, but we don't even do live streams. So maybe we will.
I just love. There was a bunch of conspiracies about, because Taylor Swift sprinkles a few like hints throughout her interviews of, I think, the number 60, the number 46, which is all leading to
the Illuminati
her
conspiracy theorists are back
doing the Super Bowl halftime show. So.
Oh,
anyway,
well, it's here. It's Santa Clara this year, Sally, in our hometown here. So that would be very exciting. The interesting headline that I read this week was that Beyond Meat is filing for Chapter 11 bankruptcy. And I think that I'm one of the only people that thought that was interesting. But I thought that the storyline of Beyond Meat versus Impossible Burger was interesting because it was like a classic sort of tops down, which was Impossible Burger kind of going through restaurants, and then bottoms up Beyond Meat going through like the homes, right? Like retail, people were cooking Beyond Meat at home, and then it was going to be this fight for the middle and this classic sort of like which path builds a stronger brand. But I feel like, as we discussed in the group chat, like the concept of fake meat was like never a good one. It's like unhealthy.
Well, I think when it first came out, I thought, or at least on the marketing side, I thought as a consumer that it was actually a healthier alternative to red meat, which obviously I didn't really read into the details of that. So I started eating those alternative meat because I thought it was healthier for you, but it's actually a lot worse for you. So once I realized that,
Yes, and it doesn't have the benefits of meat, which is like, a lot of protein and other vitamins and nutrients.
I think we're in this moment where like seed oils are evil, ultra processed food is evil, and so anything that is like I think the number of ingredients and the processing that goes into making non-meat taste like meat is just unpalatable in this time. I'm like a huge burger fan. Like it's a big part of my identity and personal brand. And I remember like, wow, total flashback. I don't know if it was like when the conference was still called like, D9 or whatever, or when it had been rebranded to Code Conference. But I remember many years ago, I think it was Impossible that had like a sort of stand in the little food court, and like trying the first one, and like a lot of friends were like, oh my gosh, Ashley, you love burgers, you have to try this. And I literally have a video of me trying fake meat for the first time. And my
what
face
was your
is
reaction?
So sad. I'll share it in the group chat, but it was just kind of like all this excitement, and then like, oh man. And I think if you like love burgers, like I don't know, there's no substitute for real meat right now. But my hope, I actually like diligenced a few lab grown meat companies. Not to freak out my LPs, I did not make any investments. It's very outside of my wheelhouse, but like from a place of curiosity, and that's the trend I'm like more excited about. It's kind of amazing what you could. It's not commercially viable yet because it's still way too expensive to do. But that's growing like actual meat cells, and it's much easier to do it with like sort of, ground meat versus like hard to grow a steak. And so, maybe in 10 years, like I'm an animal lover, but I'm also a meat eater. And so maybe in the future, those two things won't be in conflict. Okay, moving on before this becomes a burger appreciation podcast. How about we talk about psychedelics?
Yay! Okay, so I was sharing in the group chat that last week I went to this dinner hosted by a VC, and it was like a women in VC dinner, and they brought in some really interesting speakers from MAPS to talk about psychedelic assisted therapy. And I think for folks who have been exposed to this, just the idea that it can be a real some of these medicines are effective in treating PTSD, and there's a movement to legalize it, and so there's a lot of discussion around that. But I thought the two most interesting observations I thought from the dinner were so the room was just full of VCs, right? And everyone was so like curious and dumbfounded, like why the folks from MAPS were so experienced with working with people specifically in VC and PE. And I sort of felt like I was like on crazy pills, and like, because it's really expensive. And like,
how much
because we're all really broken people. That is why.
I mean, I think that's where most people were going. And I was just like, because it's extremely expensive and inaccessible, and there's only a group of people that
how
can.
Much is it? I have no idea, like conceptually how much.
It is. I mean, because it's assisted, you're paying somebody
I see.
hourly, right? And that's several $100s. And then there's the actual like the actual medicine itself, or whatever it is. The second thing that I thought was so interesting was because everyone there was a venture investor, right? And so, I think there was generally like positive affinity and sort of like the belief that this could be very good, for net positive for society and a lot of people who are very hurt. They were sort of like, they couldn't take their venture capital hat off. They're like, how do I make this like VC scale? How do I get this to VC scale or like VC backable? And that was like a really interesting tension because, I said specifically, psychedelic assisted therapy. It's not the access to drugs, once you go through the legal hurdles and all that doesn't scale. There's telehealth and all of these things, of course. It's the, how do you scale the like person who is with you, for the entire journey. And that was just super interesting. And then that made me wonder, like, where else do we see that sort of right now in AI and the discussion around like, the pieces, the services components that don't scale? I know we're all working very hard to make the services components scale, but yeah.
Yeah. It's funny. I actually do have an investment in this space called Journey Clinical. And what they have built is like the clinical back end to enable therapists to incorporate psychedelic medicine into their practices. So Helen, if you saw a therapist and they're doing more traditional forms of therapy, like they could work with Journey Clinical for the training, the prescriptioning, the guidance, all of that fun stuff. And it's actually really interesting. Something that I've been thinking about a lot is like AI is maybe coming for like the broader profession of therapy, right? You hear about all of these like AI therapy apps. People are using ChatGPT and Claude in like very therapeutic ways. And so the fact that it doesn't scale without people might actually be a really important thing for this profession. Like, how do you incorporate, different practices into your like offering that AI can't take and can't automate away? And so, and I do think from a regulatory standpoint, like maybe someday AI will be able to like guide you through, psychedelic assisted therapy, but that's
or a robot shows up at your door and they are there to monitor you and administer and all of those things. I don't think that's crazy.
I mean, but is the robot just there as a human form, just like conceptually, but you really just need the voice assisted therapy, or is that not the case? Because like then I don't think it's far off for a voice assisted AI to help guide you through a journey. The one thing I was thinking about while you guys were discussing this was, I think it was Sam Altman said it after the GPT-5 release, that yes, a lot of people are using ChatGPT as therapy, but none of it is HIPAA compliant and none of it is confidential. And so there's a lot of guardrails that need to be put in place before all this comes out. And if that doesn't, I'm very curious how the therapy space will continue to scale.
I think there are companies like MindBloom comes to mind. Like the version of this that is like legalized is ketamine. And ketamine is great because it's like a very short trip, right? Like you can do a 30-minute ketamine session. I'm fairly certain that with MindBloom, you don't have someone with you. It is all a virtual, like you go through their process, you get a kit, you are assisted, but you're assisted virtually. And so in that sense, it is actually much easier to imagine. We don't need a robot who's like fully able to like come to your home and sit with you. Like that feels quite scalable. And then I think like the other, like MDMA and then psilocybin are much like longer journeys. And so that is where like you might need that like in-person assistance. But that's super fascinating, Helen. And I will say it doesn't surprise me remotely that there are people fully focused on the venture and PE customer segment.
Totally. So another headline we saw was Dario at Anthropic apparently telling one of its largest investors, Menlo Ventures, that it needs to invest using its own capital and not through SPVs. And so SPVs have come up several times on Great Chat, seasons 1 and 2. And so that sort of reminded me about like, well, what specifically is he talking about? And right now we are seeing and hearing a lot more of these like super hot, SPVs into very late stage, big rounds of OpenAI and Anthropic. And it speaks to what the demand is, for these companies that people want to slice. But I think the specific thing that we're seeing commentary on is that a lot of these SPVs are multi-layered. And so what that means is that, that we're just putting more middlemen between the company issuing the shares and, the person who is, buying into a piece of the ownership within that SPV. And so when they say multi-layered, it's like, it's an SPV inside of an SPV inside of an SPV. And so you're getting people who like are starting to like not have any connection to the original, sort of person who's leading the SPV and is on the cap table. So any experience with or thoughts around multi-layered SPVs that
Helen,
are for chumps here? Yeah.
Isn't it also true that like it's not just that you're disconnected from the actual company, but like there are stacked fees. So just like with funds are normally like 2 in 20 is the norm. Some SPVs adopt that, which is pretty wild because it's just like one company that you're managing versus a full portfolio. But let's even say it's like 1 in 10. Mm-hmm. If you are in an SPV that's in an SPV that's in an SPV, your actual exposure to the underlying equity is like very diluted by this like layer of fees and carry.
Because a portion of what you are putting into the SPV is being taken out by fees, right? And then the carry, the 20 part, right? It's like anything that the SPV returns, the person who's managing it for doing very little work, right, gets to take the first 20% before you get, your returns. So that was interesting. And it reminded me of my time at AngelList because, when you look at structures like this, like, and I think I've said before that SPVs are a great vehicle for transfers, like when you're trying to transfer ownership and there is transparency, at every stage. So if the original, if the founder is aware that there is this SPV and they know who the person leading the SPV is and who the people who are buying the SPV are, like that's, transparency. And then the other important point is that there isn't information asymmetry, meaning like there is information flowing, and that the person who, even if you're on a 10-layer SPV, like at the very end, is getting information, from the company, and it is, truthful. I think those are like ways that it can work and be fine, and just like from a utility standpoint, be absolutely fine. The problem is, I think, when there is asymmetry in information, and that's often what happens like with these layers, and you always have to point to like who benefits here, and it's the person who's leading because they're taking a fee, right? And it's also the company who's facilitating it. So I was really excited to see that AngelList, they banned multi-layer SPVs earlier this year, and that was, while I was at AngelList, like that was a big sort of like shadow over the brand, because I think, there were some instances of SPVs, gone wrong. And, that was something that like we were sort of constantly battling with. And even now as an emerging fund manager, when I meet LPs, they're like, oh, you worked at AngelList, you must do a lot of SPVs. And I'm like, I actually don't touch them. And so I don't know, it just reminded me that like, if you are a platform, which AngelList absolutely is, like and people always ask me like, I'm running an API company or I am building a platform. Like, how do I brand this platform? I'm like, well, the good news is all that pressure is off. You don't have to brand your platform whatsoever, because your brand is, the people and the entities and the businesses that are built on top of the platform. And so companies like AngelList have to actually be very mindful of, what is happening on the platform. So in the case of like there being multi-layer SPVs, it's bad for brand.
It's interesting. It's almost like the cost of being such like an innovator and making something accessible or productizing. Like, I think about early AngelList and how it was so synonymous with syndicates for me. And then like even some of those early syndicates, like I thought of AngelList as like Jason Calacanis's investment.
Totally.
He was an early syndicate leader and was very
on the platform. Absolutely.
Yeah. And so like how you feel about Jason Calacanis might determine how you feel about AngelList, which is like a wild thing. Helen, I'm curious, like the Anthropic complaint about Menlo, do companies not know, like if so Menlo must have run an SPV for like a subsequent Anthropic round, which makes sense because if they invested early, like, and they have pro rata, they're going to have like a big chunk accessible to them. Are they, and maybe this is specific to the terms of that deal, but are they not required to report out on like whose money is in that SPV when they invest? Because that just feels wild to me, especially when you're an investor on the cap table and like want to have like a great relationship with what is going to be like what maybe the most important investment you've ever made.
Totally. I'm not sure that the person who's leading the SPV is required to disclose everyone. I mean, the founder could ask and, maybe they would disclose it. But I think like, and I don't know the details here, but what would make sense to me is that in order to fill an SPV, you have to send it around, right? And so if you're a founder, you're like, what the heck? My investor is like basically selling or marketing an opportunity to invest in this SPV. And I don't want that information out there. I don't want some random person, right? And so I think it's probably more the activities involved in filling the SPV versus like the actual filling of the SPV, if that makes sense. But I'm not sure. I don't know any details here. But that's like, I still am subscribed to so many syndicates on AngelList just from having worked there. And so I just get emails all the time. And, some emails are great and others are just like, yikes, I can tell you have not a lot of information and the founder does not know that this is going on. And that's really hard.
I did talk to an investor who got into the last OpenAI round through an SPV, and it was a multi-stage fund. And they said that all they got was a 5-page memo. Luckily, that fund had a relationship with one of the senior executives, so they did a side diligence to get the team comfortable, but it was a large chunk. And then I also, like this time around on the Anthropic side, I've been even asked from folks asking if they could try to get into the Anthropic round for $50-60 million checks. And it wasn't like they were asking for any information. They were like, hey, I just want to get in. Is there a path in? So it's just continuing to pile on. And, that's where when the information, you don't have that access, it's going to get a little bit more complicated.
Yeah. Maybe in a future episode, we can talk a little bit about another path to solving this problem that some companies like Robinhood are working on, which is tokenized private shares. There was that little blip with them announcing they had OpenAI available, and it turned out I think that it was into an SPV, and Sam had to
they didn't even mention it.
This is not access to OpenAI equity. So yes, the sort of gold rush, FOMO mentality is leading to some crazy activity. But should we head over to our main topic and dig into this Mercury report?
Let's do it.
So headline sponsor of Great Chat Pod and fintech darling Mercury surveyed 1,500 early stage founders across the US in May to understand how they're really navigating the current economic climate. And the report was released this week, and it's titled The New Economics of Starting Up. And it showed us that despite excessive capital, AI anxiety, and macro uncertainty, founders are charging ahead. They're optimistic, spending more, and rewriting the startup playbook in ways that challenge some conventional narratives. So we got a chance to get an early preview of this report, and we picked out some of the things that we thought were most interesting. And so I'll kick us off. One of the most surprising findings was around AI as job creators versus job killers. I think that we've heard a lot of discourse around AI is coming for our jobs, entry-level roles, sort of repetitive tasks. But actually, this study found that 79% of AI adopting companies with significant AI adoption are hiring more because of AI, not less. And so what do you think of that?
I mean, it tracks to what I'm seeing in my own portfolio, which of course, is not 1,500 startups like Mercury's survey group. But yeah, it absolutely makes sense. I think the AI companies, the companies that are growing faster are hiring faster. Teams are still scaling with businesses. And it's funny, I was reading the Mercury report right before a conversation I had earlier this week with a founder of an AI native startup. I won't share too many details. But this is a company that launched 2 years ago, has really taken off. They're up to 50 employees. They're hiring like crazy. A lot of their go-to-market has to have a ground game. And so there was, while AI has streamlined parts of their business, to be able to meet the demand and meet the opportunity they're seeing, people are still really essential. And so I kind of love that as a counter narrative. And I think it's a counter narrative that exists primarily in the earlier and maybe growth stages. I mean, at the largest company level, we're seeing layoffs, right? I mean, Microsoft being a recent example of this. But yeah, it totally tracks with what I'm seeing in the early stage world. How about you guys?
I mean, I thought about marketing, right? Where, if you had asked me 10 years ago, what roles within a marketing function would I think would be replaced by AI, I would have had very, very clear and immediate answers. It would be marketing ops related, because they're very repetitive tasks. And I sort of, as somebody with always finite amount of headcount, you're making these trade-offs. Okay, well, I have to have a marketing ops person because our operation, our growth team is growing at this point, which means I have to sacrifice maybe somebody on the brand side or another product marketer. And my thought is that now with AI, it's not like marketing teams are nope, I don't need the headcount. They're just going to find other ways to fill the headcount. And almost well, now that AI is doing that role and providing us with more insights, right? It can actually make other people on the team better at their jobs. And so let's increase our goals, right? Let's raise the bar and, invest here accordingly. Because typically you don't take venture capital unless you are in investment growth mode. And marketing is one of those functions that you have to pour money into, right? In order to sort of get that hockey stick growth. And so, this to me tracks as well where, just because you automate some functions, it doesn't mean that great, cool. It's, you're going to have these standalone single person teams.
Yeah, I was talking to a founder a few days ago who was telling me that the days of these large SaaS contracts are over. So looking at Salesforce or Workday, they're like, look, these companies are not catering towards smaller stage companies like the one that the founder is at. And so they're like, the CEO brought in 3 junior engineers to sort of vibe code something that was more suitable for this like SaaS in a box for that company. And he was like, look, the 3 junior engineers were much more efficient and cost efficient than, the large contract that I would have had to purchase for a monthly SaaS fee. And I think we might see more of that too. That's going to be more customized for smaller scale, and rather than these bigger companies that are trying to fit into to sail into the smaller funds.
Well, that's so interesting, like the build versus buy conversation. Like we've been in a buy mode for so long. And if you're in a build mode, like you need more people who are like concepting those products, like vibe coding those products, making sure data is like secure with those products. Maybe you have like more touch points, and so you need more marketing. And so it's really interesting to think about, if you're not like sort of solving core business problems with like these sort of more generalized SaaS platforms, maybe you do need more people on your team, and that spend is going towards humans instead. It's like not the way that I've thought about this before, but it's super interesting.
Yeah, like if you're a founder that doesn't have the baggage or the overhead from like, the pre-AI era, right? And you're starting a company from scratch, like right now, today. How do you think about AI, especially when the technology is moving so quickly? But like when you're thinking about building the team, like that's something I'm, talking to founders about all the time. But like curious if you've seen specific sort of plans. I invest so early that they're not at like headcount planning stages, but like Ashley, maybe you've seen sort of like the way that they're forecasting at least like company growth.
Yeah, it's so interesting. I had a conversation at a lunch yesterday where we were talking about like how the roles are changing, and especially as sort of these like coding technologies get really good, like a swing towards more generalist over specialist. So like as you think about building out your tech team, instead of like, oh, okay, I need like front-end engineers and back-end engineers and like infrastructure people, but like you actually maybe just need technical, product-minded, design-minded people who can like cover a lot of those areas. And so I haven't seen that necessarily show up in my companies yet, but it's going to be really interesting to see if the actual roles people hire for are scoped very differently than they have been in the past. And I think it's the more traditional software engineering entry-level positions are the ones that we've sort of seen reports of like those people not being able to find work. And so there's a question of like, if you're an early stage founder, how are you building your team? There's also a question of if you are like a student today and thinking about like, okay, like how do I start to like assemble the building blocks of my skills to meet this world, it might look very different than sort of the major or the path that you'd have picked even 5 years ago. This is like in direct contradiction to the mythology of everyone's been talking about, who will be the first like $1 billion revenue one person startup. And like that is still very much like a myth that hasn't been delivered on yet. There's Helen, you were talking in the group chat about like the seed strapping concept, which is also
like very catchy, very clicky, right? But it's not actually done very much in practice, because like seed strapping makes sense, I think, when you're like the only player in the market, you're growing explosively and nobody knows you exist. Because if you were, like growing in public and people like, you'd have people flocking to the category to build the same thing. And to satisfy all 3 of those criteria is very hard. And so I think people are still opting to take venture dollars and sort of like, get that big push in the beginning and shoot their shot.
I have one of those companies in my Fund One portfolio, and like I won't name them because, as you said, being under the radar is
exactly
like part of the move. And
exactly.
Like they are not hiring, they will not take more capital. They are growing beautifully, and I'm like trying to get them to take more, and I respect it. They keep saying no, and actually this brings us to our next question. Like I think the seed funding was enough to get them started, and now there are other sources of capital that are available to them that help them scale their businesses, so like debt financing, et cetera, and so they can grow in like non-dilutive ways. Maybe I'll take us to the next finding that we found really interesting, which was around sort of more diversified funding strategies, so not just venture capital, and that companies that had more than 4 funding sources and were raising venture were 40% more likely to raise rounds of 5 million plus. So founders who are more creative on the sort of fundraising and capitalizing side actually are more successful in raising venture. Any thoughts there?
Maybe just a note, when we say diversified funding, on the list is self-funding, friends and family, angel investments, VC, revenue-based financing, business loans.
And that makes sense, right? If you're a founder who has a network that can like get you to your angel round, or have friends and family who can put in capital, you're probably just generally going to be better networked and better positioned to raise that venture capital, especially if you are able to raise, a smaller amount to get started. It can be easier to get people's attention if you have that early traction. So that really tracks. I mean, I saw an interesting tweet this week that was around like who is venture for, which I think this like kind of gets at, right? And the person was saying like, historically really only like 1% of all startups should even raise venture capital. And now with AI and being able to build so much more efficiently, it's like 0.1% of startups should be able to raise venture, because maybe you can get to $1 to $5 million in revenue just on that friends and family round or on that angel round. And so why sign yourself up for that, like, the crazy expectations and growth benchmarks that come with venture. So yeah, I'm curious, like what do you guys think about in terms of like who should be raising venture right now?
I feel like if you think about the last few years, we saw a lot of venture dollars going into CPG, and that hasn't really panned out well. And then this conversation came up last week. I was actually in Italy with a friend who invests in sports teams. And we're seeing a few VC players go into investing into sport teams. And I'm not really sure if that's also a venture return. So Alexis Ohanian's fund invested in Chelsea Women. And, there's a few others that are in the LA soccer on the women's team. So I think those are probably reserved more of a private equity play. So that's one example that comes to mind for me.
Venture-backed startups are all about, like, can you break the rules of company building? Can you grow in unnatural ways if you're given this unfair advantage of a bunch of capital before you're profitable, before you have revenue? And, like, can you keep raising the bar beyond what should be possible? And I don't think that's, like, a universal definition, but I think it is a helpful lens of, like, do I want to be on that kind of track? Or do I want to build a business that, like, grows like thoughtfully and, with my customers over time. And, a venture can be such a default. Like I get so many, I'm sure, Helen and Sally, you do as well. I get so many pitches for businesses that have like no business, cold pitches, have no business raising venture capital. And I don't think it's the fault of those founders. I think it's become, as like the tech industry and venture has become more visible, outside of this, like what was once a small ecosystem, people think this is just the way you build businesses. And it's not to say that venture couldn't adapt for that, but the way it is structured today and the way most funds, like the way we do our fund math, like does not work for backing those types of businesses.
That's right. I think in 2021, where there was just so much capital to deploy, we had a lot of CPG founders who were not on the venture track, who were convinced to take venture dollars. And they regret it because they knew that these investors are software investors, and they would be, as they quickly found, like compared to sort of software scale and software timelines. And you just don't have those margins in CPG when you're shipping, physical and manufacturing and shipping like the physical products. And so, I think that like there are outliers, of course, here, but usually they're getting like massive economies of scale, or there's something that's up, right? And so generally speaking, I don't know if venture makes sense for CPG or even e-commerce. And I also think that, I mean, this is like a hot take as somebody who used to invest a lot in e-commerce, is like, I think we had a golden period where, you know, we had meta ads working so well. Like, you know, the question I would always ask is, if Warby Parker were to launch today, what channels would they use? Because they sure would not use the same channels that they did when they launched, right? And they were using Meta so effectively. They had really low cost per acquisition. You could build a sustainable business, a venture backable business. But then iOS 14 changes came out, and, you know, that sort of changed the game on, you know, making Meta ads like ROI positive for a lot of these businesses. And a lot of them don't have a plan because they built their financial models and raised money according to like those old calculations.
Yeah, I mean, I saw this firsthand at Glossier, and beauty does have, it's a very high margin business, and it's also a fairly acquisitive industry, right? So we've seen like $1 billion plus acquisitions even just this year. But I joined before Glossier's first unicorn round, you know, after a year where they'd done 100 million in revenue, so like real scale. There were reasons to be excited. Glossier like grew, to your point, Helen, about like the sort of customer acquisition piece being so core. Like Glossier grew with Instagram as a channel. But that unicorn round was like a lot of pressure to start to think like a technology company. Should we hop over to our Q&A? We got a great question as a follow-up to last week's podcast, which was sort of all about fundraising and prepping for peak fundraising season, which is fast approaching in September. So maybe I'll just read this and toss this over. I'm raising my first round venture. Should I call it an angel round, a pre-seed, a seed round? Why does it matter? And also, can I change that later?
Yeah, I feel like the whole naming convention has like totally gone out the window. First of all, the like value of the check size. We did our first round, which we labeled pre-seed, but also mostly angels, was the $5 million pre-seed round. And so I think I'm curious like what you're seeing, Ashley, because I don't know, some people are just changing the names based on like what the narrative that they want to tell. And so
I think it's like a super important thing to jump into, and like all these labels are just labels, but I think it actually really does matter. And here is the lens in which it does matter, which is that whatever round you're raising, so let's say you decide you're raising a seed round, you are kind of also kicking off the process for the next round. And so in that case, the Series A. So what investors are evaluating is, do they think that you can hit with the capital you're raising the milestones that are necessary for you to be able to raise your next round? And as we've seen over the past couple years, like the benchmark for what gets a Series A done has like changed massively. And so this is where I think it actually is really important for founders to be thoughtful about the rounds that they're raising. So, you know, just because you can go and raise 5 million out of the gate and call it a seed before you have any product, like, should you? Like, you are signing up to raise a Series A. You're also signing up to potentially need to raise a seed extension to get to those metrics. And so this is where like my hot take is like optionality is everything. If you can call it a pre-seed, call it a pre-seed. And then if you have enough traction to make the next round a, $15 million Series A, that is great. But it also gives you room to raise like a really strong seed, in 12 months if things are going well. And so that's like my number one thing. But the thing I will say is it is tricky because a lot of investors like don't do pre-seeds. And so it does also change the set of who you pitch. But yeah, I'm a big fan of like optionality and especially with Series A's being pretty hard to get done outside of certain super pedigreed AI companies. Like give yourself a little bit more space.
Yeah, I feel like I've seen a different naming conventions for seed extensions or Series A extensions that never heard of before. So
for a while, Seed Plus was like the Zerpy rebranding of the seed extension or the bridge. Remember, it was called a bridge round, like back in my day. So yeah, it's really funny to see people. I've also seen pre-Series A rounds. Like everyone's playing with the
very creative.
Yeah. And I respect it. Listen, like if you can tell a story around like this is your last chance to get in before my big Series A, but you better have the metrics to tell that story.
Yeah. I think that's a good place to end.
Amazing. All right. Well, we'll see you guys next week.
See you next week.
Thank you for listening to Great Chat. Have questions for us? Make sure to submit them at anothergreatchat.com. See you next week.